Profits at Bank of America and Morgan Stanley more than doubling during the fourth quarter, cementing a robust 2024 for big banks as Wall Street gets optimistic about the upcoming Trump administration. Joining us now, we want to bring in Stephen Biggar. He's Argus Research Director of Financial Services Research. Stephen, it's great to have you back here on Yahoo Finance. Let's start with the two banks out here this morning. You had Morgan Stanley, their profit doubling, same with Bank of America, but Morgan Stanley citing election volatility, some of that macro data helping their numbers. Bank of America, their revenue was up 15% in the most recent quarter. What's your big takeaway from some of these blowout prints?
Yes, good morning, Shauna. So yeah, absolutely. The global banks are kind of the stars of the banking universe right now in terms of earnings. That big resurgence in all things investment banking, whether it's M&A activity, a little bit in the IPO side. You've got good debt underwriting as well, and trading results were a little bit down from the third quarter, but still strong year over year. So that's been kind of the trend. That was the expectation. Not enough time to really goose the the results following the election, but certainly the commentary from bank managements has been that it's much more constructive conversations with clients, particularly about the M&A pipeline. So it looks like we feel there's a pretty durable rebound underway here.
It's interesting because in looking at some of your top picks, JP Morgan, Goldman, Morgan Stanley, and Citi Group here, it strikes me that not only do they obviously have that M&A pipeline, but also a huge investment into private credit specifically. How much do you anticipate that being a future catalyst for some of these big banks?
Well, yeah, to the extent that the private credit industry, the alternatives have kind of marched into the territory and taken some share away from the overall lending environment. So banks are making a real push. We saw with Goldman's announcement of creating a new basically division to attack that, and they're obviously going to go after it pretty strongly. So the point being, I think the rest of the lending growth environment has not been that stellar, whether it's general consumer, commercial real estate. Very low to single digits to even 0% growth we've been seeing. The regional banks, I think, to the extent you're seeing some weakness in the stock prices today, some of the guidance there has been fairly weak. Looking for a downward trajectory with net interest income for the first half of this year before troughing and seeing a better second half. So yeah, there's a big push into private credit. That's been a very growthy area overall. For the economy, and these banks are going to make a concerted effort there, sure.
Before we go on to the regionals, and I want to get your take on some of the numbers that were out this morning, including PNC, which I know is in your coverage, but sticking with the big banks real quick, because it looks like many of them, obviously, or all of them, you can essentially, I think, make the argument for set up to do relatively well in 2025. What is your top pick coming out of this earnings season?
Well, the narrative is not too surprising with, particularly for the regional banks, they're more beholden to loan growth. They don't have the 50% of revenues roughly that the global banks do in terms of capital markets revenues. And that's, again, where the real growth has been coming from and is expected to moving into 2025. So lending growth is again, very, very sluggish. And I think the narrative it stays that way until rates move down. We have this elevation of the long end of the curve. We have a little bit of reprieve at the short end as the Fed funds rate moves down, and that affects the prime rate and certainly a number of lending categories. But there's just been not a lot of excitement from consumers or commercial to take out loans at these levels. The better story is net interest margins, at least, because as that short rates have moved down and long rates have moved up, we have a steeper yield curve. So that helps bank lending profitability. So for each new loan they bring on, it'll be at a better lending profit. But you have to have new loan growth to help the situation, and that just does not seem to be in the cards in the first half. As it's certainly not our house view that rates are going to move down materially from here. And I don't think it's in too many other house views either.
Yeah, I want to talk about the sort of Trump bump that's already been priced in to these financials here. Obviously, a lot of excitement about financials under Trump 2.0, but banks just had their most profitable year under Biden, second only to their most profitable year, which was Biden's first year in office. Is the market potentially over-indexing how great Trump is going to be, not just for kind of the major banks, which are featured on your screen here, but also for regionals?
So I think the bank stock story here is that, and yeah, the banks had a terrific 2024. I would caution, though. I think a fair amount of that was actually because of the first half of 23 was very much a debacle for the group at large because of the Silicon Valley Bank collapse and the deposit crisis and so forth. So 23 was just absolutely not a good year. So there was a good recovery in 2024 that was, certainly put behind. But the narrative more recently has been around a growthier economy under a Trump administration, certainly since the election. Financials were on fire in the early weeks after that. And this notion of deregulation, and in particular, we have the vice chair of supervision that the Fed has stepped down. So we expect, even if it's no changes or no significant changes to regulation here, I think the bank group can have a lot more flexibility with capital, and that's good for lending it out, for example. It's good for buybacks, good for dividends. So we'll get a lot more transparency, I think, around the C Corp process here. And then, of course, the deregulation also in terms of just a more lenient Justice Department and Federal Trade Commission in terms of getting merger and advisory deals through through that regulatory muster is going to be beneficial for free deal flow.
All right, Stephen, thanks so much for joining us. Appreciate it.
Thank you.